is the 3rd of May 2023. My name is David Hickson, and in today's market update I'm going to be taking a look at the S&P 500 and also the Nasdaq, and speaking about the way in which price interacts with the FLD, which is of course my favorite Hurst cycles tool. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So let's start with the S&P 500. This is data from my trading platform, which is actually SPX, but of course the two are very closely related. The important thing about this analysis, which we speak about in pretty much all of these market update videos, is the fact that I now believe that the 18-month cycle trough occurred in the middle of October. You'll notice that those diamonds are hollow, indicating that according to this particular analysis, that 18-month cycle trough has not been absolutely confirmed. What that means is that the software has performed an analysis and it believes that the 18-month cycle trough did occur there, but it needs a little more evidence, such as price crossing cleanly above an FLD or a VTL. It doesn't use a single piece of evidence, it uses a collection of evidence, and so it is presenting hollow diamonds over there. And we have an 80-day cycle trough over here, which occurred just before December. And if you go back and take a look at the market update videos, which I would encourage you to do at around about the time of these troughs, you can see how we anticipated the formation of these troughs. And then, of course, we had a 20-week cycle trough that occurred over here in the middle of March. What this means is that we have a nice, neat M shape over here for this 20-week cycle trough. And as I have discussed in recent market update videos, we will expect to see another M shape play out for the next 20-week cycle trough. We are expecting price to come down into an 80-day cycle trough, which is expected towards the end of May. As you can see, there's the nest of lows, and here is the rather straggly nest of lows for the 40-week cycle trough that we would expect after that. In recent market update videos, I've spoken about the fact that these circles often don't line up. It's because the software is looking at previous iterations or waves of the particular cycle to calculate the recent wavelength. And when it comes to a 40-week cycle, the recent wavelength is looking back something like 240 weeks. So it's looking back quite a long time to calculate that. And so we pay more attention to the shorter cycles in these nests of lows. And so for that reason, we believe that the 40-week cycle trough is probably only expected round about over here sometime in July. And so we would expect an M shape to play out. Price is going to move down into the 80-day cycle trough, which will occur somewhere around about there. Then it is going to bounce up again, and then it is going to come down into the 40-week cycle trough in about July. Now, I have rather subtly sneaked in a bearish M shape, as you can see over there, which has been the discussion of recent market update videos. The fact that we had a bullish M shape in this first 20-week cycle following the trough in October, and the next M shape might not be bearish, but it is expected to be less bullish than the cycle that elapsed from October to March. I spent some time discussing that. I believe it was in the previous market update video, which was about 10 days ago, because I recorded that on my usual schedule on Monday of last week. This week's market update video is just a couple of days late because of the public holiday on the 1st of May. And so that is our expectation. Now let's zoom in and take a look at what is happening. And as I mentioned earlier, I am going to be focusing on the detail of the way in which price interacts with my favorite Hurst cycles tool, the FLD. So first of all, in the previous market update video, which as I've already mentioned, I recorded over here on Monday, I think that was the 24th of April. In that market update video, I discussed this 40-day cycle trough, and I presented various reasons for believing that the 40-day cycle trough might have already occurred. What has happened now has been quite interesting, because prices come down and formed a much clearer trough over there. As you can see in the analysis at the foot of the chart, the fact that we are still seeing this nest of lows indicates that the software is inclined to position that 40-day cycle trough over there on Wednesday of last week. If we measure the number of bars, number of days that elapsed up to that trough, you can see it was 44 days. The jury is still out, in my opinion, as to where that 40-day cycle trough should be, because 44 days is fairly long for a 40-day cycle. The average length of a 40-day cycle discovered by Hurst 50 years ago was 34.2 days. And so this 44-day cycle would be a fairly long cycle. And as mentioned in last week's market update video, we are not expecting a long 40-day cycle at the moment. But of course, one of Hurst's fundamental principles is the principle of variation, which tells us that the wavelengths are dynamic and they are constantly varying. And so it is not impossible that the 40-day cycle trough occurred on Wednesday of last week. So we have these two possible positions, this position over here for the 40-day cycle and last week's position over there. One would imply a slightly shorter 40-day cycle and the other would imply a slightly longer 40-day cycle. I tend to favor the earlier position for the reasons presented in last week's video, and in particular for the fact that there is the 40-day cycle circle, which is the time at which we were expecting it, and you can see that trough that formed, a slightly strange trough, of course, in the middle of April, is closer to that circle. That was one of the reasons why I prefer that placement. But now, whereas many analysis approaches require that you resolve these anomalies when taking a Hurst cycles approach, I believe that it is not always necessary to resolve the anomaly in order to make sensible trading decisions. We don't need to make a decision about the position of that 40-day cycle trough. It either occurred over here or it occurred over there. So why do I say it's not necessary to resolve that anomaly? Why am I not forcing myself to decide which of those is the correct position? The reason for that is because of the way in which we use our analysis to make sensible trading decisions. Now, I should point out here that there are many ways of taking a Hurst cycles analysis to make sensible trading decisions. And of course, it depends very much on what cycle you're trading and what your time frame is and so forth. But a very useful tool, as you will know, because I often mention it, is the tool of the FLD, the future line of demarcation. The future line of demarcation is in fact a very simple tool. It is simply median price displaced to the right on your chart by half of the recent average wavelength. The trick, of course, is that you need to know what the recent average wavelength is. And the other trick, as I've mentioned in recent market update videos, is the fact that in order to plot an FLD correctly on an end-of-day chart or a daily chart, you need to include the weekends as gaps on your chart because of the fact that Hurst discovered that these cycles tend to influence financial markets in real time. And so those weekends, which I'm drawing little circles around on this chart, need to be included on your chart in order to correctly plot your FLD. So let me explain why I don't believe it's absolutely vital to decide now where that 40-day cycle trough occurred. Here is the sequence of interactions. Price crossed above the FLD in what we label an A category interaction. Then at around about the time of the 20-day cycle trough, we would expect price to come down and find support at the level of the FLD. There was some confusion as to where that 20-day cycle trough should be. It could either have been here, in which case the market revealed its bullishness by not coming down and even reaching the FLD, or it could have been here, as we are seeing on this analysis, again revealing bullishness in the market because of the fact that it hasn't even come down here. Or there are some analysts that might even have been considering this as a potential B category interaction. Remember, the important thing is that the B category interaction should occur as price comes down into the 20-day cycle trough. That bar over here on the 10th of April was, I think I'm correct in saying, about 28 bars into the cycle, or 28 days into the cycle that started on the 13th of March, and that in my opinion is too late for a 20-day cycle. And so at this point we would not have been considering the possibility that this was going to be a B category interaction. We might have considered the possibility that price was going to cross down below the FLD in a D category interaction. So let me write a D over there, and let me, for the sake of completeness, write a B and then C under here, where we potentially have identified the 20-day cycle trough as having formed. Now, at this point, we might have been interested in entering into a short trade. That short trade would have generated a target to the downside about over here. Let me clean off some of these pen marks and demonstrate what I mean by the fact that this was not really a very good and tradable trading opportunity. First of all, on the Monday, price came down and formed a low price over there. It seemed to find approximate support at the level of the FLD, which is a little bit of a warning sign if you are expecting price to cross down below the FLD. Price then moved up on the Monday. Then on the Tuesday, we had a pretty much meaningless day. I think that this was around a holiday period, and so these bars are not really very full bars, if you like. They don't represent full days of trading. Then on the Wednesday, you can see price came down to the FLD. However, to have entered into a short trade as it touched the FLD would have been very foolish. It would have been aggressive, perhaps not foolish, but to enter would have been premature, in my opinion. You would have entered a delayed trade, possibly, if you saw continued movement downwards, which of course we didn't. When you have recently been shown that the market still has a good deal of bullishness in it, it might be a little foolish to be jumping into short trades. Nevertheless, I have labeled this as a potential D category interaction as price comes down below the FLD on its way to the 40-day cycle trough. The fact that price found support at the FLD was another indication that there was still some bullishness in this market. This E category interaction would have been labeled over here as price crossed back up above the FLD. That labeling of those interactions would have been the situation if you had decided that the 40-day cycle trough must have occurred over here. If, of course, you hadn't decided that, then the D category interaction would be labeled over here as price crossed down below the FLD. However, let's stick with our sequence that we have been identifying, and let me point out how you do not need to resolve this anomaly. Because if you have labeled your D and E category interactions, the next interaction is an F category interaction, where price crosses down below the FLD and reaches down towards its target. So you were considering either an F category interaction if you were convinced that the 40-day cycle trough had occurred, or you might be viewing this as a D category interaction. So I'm going to write here F/D. Either of those might have been an indication for a short trading opportunity. Again, given the fact that we have been experiencing bullishness in this market, you might not have been interested in jumping into the short trade. But let's assume that you are trading every single interaction between price and the FLD. If you had done that, the target that was generated to the downside was a not very impressive target, but it was this target over here. We measure the target by measuring the distance from the recent peak down to the level at which median price crosses the FLD, and we extend the same distance downwards. That is roughly over here. So you can see that target was accurately achieved, and then price bounced straight back up again as it bounced out of this trough. So now we still have an anomaly in the analysis. We don't know where this 40-day cycle trough should be positioned. Is it over here, or is this the 40-day cycle trough? Now, this is where the difference between the trough placements will affect us in terms of our trading. If this is the 40-day cycle trough, then we would expect the next interaction to be an E category interaction. An E category interaction, particularly when the market has been bullish, would generally result in a profitable trade. However, don't forget, we have this anomaly. We have the question marks around the position of that 40-day cycle trough. If the 40-day cycle trough has occurred, which I spent some time discussing in last week's market update video, then of course our next interaction is the G category interaction, where we would expect price to come up and find approximate resistance at the level of the FLD. And so let me clear these marks and focus quickly on the trading decision that we would have faced last week. If you had watched my market update video, you would know that I had good reason for believing that the 40-day cycle trough had already occurred, which meant that the interaction we were looking at was going to be a G category interaction, where price should be expected to find resistance at the level of the FLD. We do not go long at G category interactions. However, you might have been looking at this chart and saying to yourself, well, I think that's the 40-day cycle trough over here. here, even though it was at a length of 44 days. If that is the case, then I would be looking at an E category trade. Here, the fact that we have an anomaly in our analysis in terms of the question marks around the position of that 40-day cycle trough would lead us to have an anomaly, if you like, in making our trading decision. When that occurs, I have found it better to take the safest option, which is not to jump into a long trade, but rather to miss your trading opportunity. Of course, different traders will have different approaches. So what are we expecting to happen next? Well, we are expecting price to come down into an 80-day cycle trough. And if we measure the number of bars, since the trough in the middle of March, the average length of an 80-day cycle is 68 days. And so on about the 20th of May, we would be expecting that 80-day cycle trough to occur. You can see that the circle for the 80-day cycle trough is a little bit earlier in the analysis. That is because the recent average wavelength of the 80-day cycle has been calculated to be shorter than the average wavelength discovered 50 years ago. And we also have a rather straggly nest of lows over here, presenting the possibility that this cycle trough might occur a little bit later, perhaps even in the first week of June. Why is that? It's because of the fact that the 20-day cycle trough has been found to have occurred over here at a slightly late position. This might be a better position for it. And of course, Sentient Trader then would be lining up the next 20-day cycle trough under this trough that occurred last week, leading us to expect the next 20-day cycle trough to occur over here in the second week of May. And of course, the next 20-day cycle trough, which will be synchronous with the upcoming 80-day cycle trough, is only expected over here in the first few days of June. If we believe that the 40-day cycle trough has occurred over here, then our E category interaction was a very disappointing interaction which didn't even reach its target. We are looking at an F category interaction about to occur now, or in the process of occurring, I should say. An F category interaction usually gives us a good short trading opportunity. On the other hand, let me clear those marks. If we believe that the 40-day cycle trough occurred over here, then this was our F category interaction, and this was simply a matter of price coming back and finding very approximate resistance at the level of the 20-day FLD in what we would label a G category interaction. Again, indicating that we have a short trading opportunity coming next, bringing price down into this 80-day cycle trough. Now, I would like to point something out about these FLD interactions. We've received many emails recently asking whether we are already in our F category interaction or trade, and there's some confusion around the terminology that we use here. So let me explain how we use the terminology in terms of price interacting with the FLD. First of all, we identify interactions between price and the FLD. That is where price crosses the FLD, or where price finds support or resistance at the FLD. That is an interaction, and that is where our process starts. We label the interaction. It is where price crosses or finds support. As a result of that interaction, we might take a trade, and the trade is triggered as a result of that interaction. So this interaction that occurred yesterday between price and the FLD might be labeled an F category interaction. The trade that we could take as a result of that would follow after the interaction, and we would label that an F category trade. So we have an interaction and a trade. There is often confusion about this terminology, and that is largely because of the way in which it differs from the way in which Elliott Wave tends to label the moves that an Elliott Wave analyst tracks. Let me do a very approximate Elliott Wave analysis over here, and I am by no means an Elliott Wave analyst, but here we have 5 waves up in a potential impulse wave, and an Elliott Wave analyst would label the actual wave, first of all, a wave 1, and then a wave 2, and forgive me if this is not correct, I'm just trying to make a point. We label the actual waves when it comes to Elliott Wave. And so we have a wave 1, a wave 2, a wave 3, 4, and 5, and that will be followed by an A, B, and C. So I hope I haven't done Elliott Wave a disservice by analyzing this very quickly like that. But the point is that an Elliott Wave analyst labels the price move. The big difference with what we are doing is that we are not labeling the waves, we are labeling the interactions. And so here is our A category interaction, here is potentially our B and C category interaction, which of course is not an interaction, but it is a meaningful moment where price moves towards the FLD, doesn't even reach it, and then moves up again. Here is again another interaction, which of course could be labeled D and E. Here is another interaction, and another one, and another one. So we label the interactions, not the actual price move. So really important thing, it's fairly subtle, but an Elliott Wave analyst might say that we are now in wave C, for instance, whereas we wouldn't say we are in wave F, because we don't have a wave F. Price has recently interacted in potentially an F category interaction. We are not necessarily in an F category trade, because although the interaction has occurred, we haven't yet entered the F category trade. Unless, of course, you were being aggressive and entered at the point at which price touched the FLD. I really hope that makes sense. We've had many questions about that recently, and I hope that clears up some of the confusion. Now let's take a quick look at the Nasdaq. The analysis in the Nasdaq is different to the S&P 500, and that is largely because of the magnitude of this October trough. Now, I don't have time to discuss it in today's market update video. It will make for an interesting discussion in a future video. We will focus on the Nasdaq, but you will notice that in this analysis, the 54-month cycle trough has been found in the Nasdaq analysis. I'm not going to discuss it today. I'm not absolutely convinced that is a 54-month cycle trough, but it does make for an interesting discussion. Here is the 80-day cycle trough, and here is the same 20-week cycle trough that occurred in about the middle of March. We have a good bullish M shape that has played out over there, and of course we are expecting another M shape to play out. It is expected to be less bullish than the previous M shape, but if this is a 54-month cycle trough, it might not turn out to be a particularly bearish cycle. I'm not going to explain that in too much detail because I expect that by now you understand that fairly well. Let's take a look at the detail of what has been happening in the Nasdaq. And it is very important to watch not just one instrument, but to watch several instruments. And one of the reasons that I say that is because in this analysis you can see that the 40-day cycle trough has been positioned over here. This is another one of the reasons why I believe the 40-day cycle trough in the S&P 500 occurred slightly earlier rather than last week. Here is our FLD in the Nasdaq, and I'm sure I don't need to go through every little minute detail, but here are our sequence of interactions, or here is our sequence of interactions. That's the A category interaction. Here is the BC category interaction. Isn't that a perfect example of price finding support at the level of the 20-day FLD for the BC category interaction? Here is our D category interaction as price crossed down below the FLD to reach the 40-day cycle trough. The target that was generated as a result of that price cross below the D category interaction was in fact achieved. It was a very miserable little price target, if you like, because of course the FLD had risen up fairly high before price actually crossed below it. Not every single trading opportunity is going to provide you with remarkable profitable opportunities. You need to be watching those targets and calculating them. Here then is the E category interaction, which occurred as price crossed above the 20-day FLD, which it did interestingly over a weekend. I'm not plotting median price here, but it would have occurred at about over there. You will notice that that E category target has not really been achieved. You might argue that it has just been reached, but it certainly was not reached by this price high on Tuesday of 2 weeks ago. This was possibly the F category interaction, or this might just have been an anomaly with price moving down and forming a rather insignificant 10-day cycle trough with this deep move down. Then price bounced up again and crossed up above the FLD. We have the same anomaly that we have in the S&P 500. Is it possible that the 40-day cycle trough, although it has been confidently placed by Sentient Trader in the middle of April, is it possible that it should in fact have occurred over here? Those anomalies would have led us to question the sequence of interactions, and we might have made this long trade or we might not have. As a matter of interest, the target for this price cross up was not achieved by the price high on Monday of this week, although it is possible that price will still continue up and achieve the target generated by that price cross above the FLD. And so we have a similar anomaly in terms of the position of the 40-day cycle trough. Even though Sentient Trader has positioned it confidently in the analysis, there is an anomaly because of the fact that we have a fairly obvious trough over here, which is it really a 10-day cycle trough? We have a question mark around that trough position, certainly. The Nasdaq has been fairly persistently bullish, but it must form an 80-day cycle trough. And as you can see, we have a fairly neat nest of lows over here in the second and third weeks of May, and price should come down to form an 80-day cycle trough. When it does, it should cross below the FLD. And the way in which it crosses below the FLD, or potentially even find support at the level of the FLD, although that is not expected, will reveal the condition of this market as it comes down into the 80-day cycle trough. This is the composite model line in the Nasdaq. The composite model line takes the information from the analysis, recomposes it, and generates this orange dashed line, which shows us what the cycle analysis is telling us the cycle constituent of the price action is. In other words, it measures the wavelengths and the amplitudes of each one of these cycles, recombines them, and if the only thing influencing this market were the cycles that we see on our chart, then this orange line is what price action would have been doing. You will notice that there is an obvious anomaly here, where price came down into this trough, which has been phased as only a 10-day cycle trough. And that potentially raises some questions about the analysis and about the positioning of that trough. But the composite model line is indicating, as I have just explained, the fact that we are expecting price to move down into this 80-day cycle trough, expected in about the third week of May. Taking a quick look at the composite model line in the S&P 500, you will notice that it handles this trough a little bit better because, of course, in the analysis, it is still expecting that 40-day cycle trough to occur. The very important thing about the composite model line is that it is based upon the analysis on your chart. It should never be viewed as a separate tool that either confirms or denies your analysis. It is based upon that analysis, and so if there are anomalies in the composite model line, it means that there are probably anomalies in the analysis. There is a slight anomaly here between price and the composite model line, and that is the fact that the composite model line expected the peak in price to occur over here, in other words, in the first 40-day cycle, and it expected a lower peak. That is based upon the calculated amplitude of each one of these cycles, and the fact that price jumped up and formed a new peak, even if it was a slightly tentative new peak over here, is a little bit of an anomaly. It might simply be an example of price running the stops and trying to find the stop orders that were placed above the previous high. And the composite model line does, of course, indicate that we are expecting price to move down into this 80-day cycle trough expected in the second or third week of May. Today is another FOMC news event, and so we should expect some volatility later on today. But once that volatility calms down, it will be interesting to see how price moves towards the 80-day cycle trough. I do hope you found this market update useful and interesting. If you have any questions, join us on our Discord channel. And of course, you are very welcome to ask your questions in the comments below this video. I look forward to hearing from you.